Anyway, so I just turned it on. Welcome, Russell Rhoads. My name is Dave, and I've been accused the last couple times of not introducing my guest well enough. So I'm going to attempt to introduce you better. Russell Rhoads, CFA, is a senior instructor with the Options Institute, and you said you've moved to business development now.
I'm a director in the global derivatives area now.
He's also a trader, an author, a college instructor. And
Yeah.
are you a PhD yet, or are you still a PhD candidate?
No, I know this is a recording, but we're speaking on Martin Luther King weekend, the Monday afternoon, and all I've been doing is dissertation work all weekend.
Oh wow!
With the exception of having to go see Paddington 2 with my kids.
How long does it take to get? How long does it take to get a PhD? Is it several years?
The program that I'm doing is through Oklahoma State University. You go there once a month for the first 2 years, and then the third year is dissertation, where you work one-on-one with a professor from the university. You go there as needed, but you can do a lot of the work long distance. I am past the end of the third year now. I'm a little bit behind. But I'm only a couple of months behind right now, so I should be finished hopefully by summertime.
Nice, that's awesome. What is the discipline of your PhD?
Well, it's a strategic management, but my dissertation topic is behavioral finance. And it's kind of got two angles to it. One is, I'm too far along for anybody to steal this. I'm taking the Forbes most admired company list and seeing if those stocks are overowned by professionals. That's one of the things that I'm doing. And then the other one is taking a look at the risk profile of different types of institutional managers in low, medium, and high VIX regimes. And seeing if they actually shy away from risk at the very time that they probably should be taking it on.
Oh, wow,
I also show that you're better off, adding to your equity exposure in high volatility environments. So just two different angles, kind of to the same thing. They're more interested in the behavioral stuff. I'm more interested in the VIX stuff.
Wow. Well, you came to my knowledge just because of all your blog posts for the VIX. I'm part of a group of guys on StockTwits, and we all trade the VIX. Most of us are kind of centered on UVXY, but we all trade the VIX, and there's a core group of us who sort of have some knowledge, and then there's always newcomers coming in, and we're constantly educating people. Probably about 80% are newcomers that are it's sort of a revolving door. And so we often point people to your articles, and we really appreciate you. You're sort of one of our heroes of our little group of guys, so in our little niche in the world. So thank you so much.
I wrote, and this is definitely not a plug. I wrote probably the first book that really focuses in on VIX several years ago. When people ask me what they should buy to read about VIX, I say don't buy anything. Take a look at the blog that we put up at CBOE, because it's free. And I try my very best through the two that I put up every weekend to show different types of option trades around, in fact, this past weekend, it was a UVXY trade where somebody put on a really cheap call spread. No, they sold a put and bought a call spread for a small credit. And if we get some sort of volatility event over the 4-day week, they'll actually do pretty well with it, as long as UVXY stays above 8, which would just involve some moderate volatility. They end up with the small credit that they took in. So that was the first time I'd seen one like that.
Well, I was looking at that article earlier, and that is an interesting trade. I like the idea of putting these trades on for credit like that. As you mentioned, I guess it was the 19th expiration. So this week, the guy bought he sold the 8 put for, let me get it in front of me. I think it was like 8 cents. The overall trade was for a 2-cent credit, but basically. Sold out of the money call, sold out of the money put, and bought the sort of at the money call. And so if something interesting happens, he'll make the $2 minus the 2 cents. So dollar
Yeah,
98, which is
I think
awesome.
they bought the 10 and sold the 12. What's really funny is we see that trade all the time in VIX. But it's the first time that I've seen it, or that I've written it up. I shouldn't say seen it, but the first time that I've written it up in UVXY. And it makes an awful lot of sense. In fact, we have an individual who is at CBOE now, who used to be involved with the ProShares guys. And she said that they showed that the closest that you get to short-term VIX in the ETP space is actually UVXY or TVIX, but TVIX, I think UVXY has a better handle to it to try and trade with. So,
Well, the only thing I thought about that trade myself was just that, like I said, I like the fact that it's for a credit, but that trade is a little bit of a not a long shot, but it's definitely you'd have to sort of get lucky to get that move. And so
yeah.
I almost wouldn't want to limit my upside completely on it. I would almost just pay the 16 cents for the call, and that way, if it does come in on the long shot, I'm gonna, and the VIX goes to, UVXY goes to 35, then I get to make the big
Well,
move.
where were we? We went out at 8. I think the biggest week is about 120% week, if I'm thinking right. So that would get you to about 20 or so. I gave a little bit of thought of, I try not to criticize them. I just throw them out there and let people think about them. I might have, gone a little bit higher on the strike that I sold, but I think there are people that, and I'm one of these. I think there are people that really like to do these things at credits.
Yeah, that's great.
That becomes the difficulty sometimes with, especially with the kind of skew that you get, because you're not going to get a whole lot for the put unless you're pretty close to where the market is when you put that thing on.
I know I hate selling an option for like less than 10 cents. It scares me. I was a CBOE market maker for many years myself, and I was brought up not to sell small priced options. So even though you're doing the trade for a credit, it's still, I feel like I'm giving away any option for like less than like 25 cents or something. But I understand the concept of putting it on for credit. That 2 cents probably pays for your commissions, and you've got this free trade. If you keep doing the trade over and over again, eventually it's going to come in, and you're risking nothing to do it. So that's awesome. I wanted to ask you. It seems like there's been a lot of increased volume in the VXX lately, and a lot of these trades are either like the 50-cent guy or other people doing this sort of spreads. You had another example of a spread in a recent post of yours where it was like 280,000 times. It was a similar concept of somebody that was looking for a spike in the next few months, and they sort of did a spread to. And it seems like a lot of these trades haven't really come in. Who would put on a trade like that?
Well, people think that we know everything about the identity. We have a good idea of what else people behind trades like this are doing, and typically it's somebody that's taking, it's somebody that's got long volatility exposure, or I'm sorry, they've got exposure to the equity market on the long side one way or another. And as part of consistent protection, maybe they allocate 1% of a portfolio and they're willing to give that up over the course of a year by putting on different types of positions. Used to be you would look for opportunities in the SPX. I think now, I don't think I know the shift has not completely gone over to VIX, but it becomes just an extra possibility there. So when you hear of somebody that's consistently doing some sort of option trade that we recognize due to the size, and they're not making money on the trade, they are making money somewhere else. It's not like somebody has been, and you and I know that, but I spend a lot of time with our corporate communications department talking to the different reporters that will report on these things and trying to explain to them this concept, because sometimes it doesn't seem to come out in the story. It's just somebody's been buying a lot of calls or doing a lot of VIX spreads. And if it's the same entity that's doing the same thing every month, look at how much money they gave up last year. Well, I have a funny feeling that they probably made a lot more of it through whatever strategy they're involved in.
And this was just sort of the hedge to it. Yeah, that
Yeah.
makes a lot of sense.
I think very rarely these trades are being done in a complete vacuum. Yeah.
I would think that some conservative investments might actually have as part of their requirements that some sort of money be put back into either, just buying SPX puts outright or doing some sort of strategy like this. In my mind, it might make sense to some of these guys just to do the SPX puts outright because you're not dealing with Contango and the other sort of drags on the VIX.
You know, there's an argument either way on this one, and this is one of the great things about where I work is I can actually go down on the floor and talk to people. I can talk to people in our research department, kind of kick these things around. And what you just brought up was a discussion that I had with some guys from research. And one of the things that you have to weigh there is let's say on the last day of 2017 you bought SPX puts. They're not doing you any good anymore. You know what I mean? Let's say the same thing. You may have bought some February VIX calls. They're holding up a lot better than the SPX puts when you get the move to the upside in the equity market. Because we used to say we had a floor around 10. I guess we'd say we have a floor around 9 or so in the VIX now. But you deal with the Contango, you deal with the grinding lower for the VIX futures where they match up with VIX. But at the same time, if you get some big bullish move out of the S&P 500, those puts that you purchased, if we get a 2% drop next week, puts that were bought even slightly out of the money at the end of December aren't going to do you a whole lot of good.
Oh, that's a great point. I hadn't even thought about that.
You know what? In that one, totally smart guy in research. That wasn't. that's me repeating what somebody else said.
So what you're saying is that by the time you get that pullback in the SPX, it's moved so far away from the strike that you bought the puts for protection for, that they're not even in the game anymore. So
depending on how the market, depending on what happens. Whereas, let's just say VIX is hovering around 10 like it is right now. If you get a 2 or 3% move out of the S&P 500, the VIX isn't gonna give up too much on the downside. You'll have the futures grind lower. I'm not saying that it's the best thing to happen to you, but the way that these things seem to hold up, and we see this with call spreads and a lot of other spreads, they seem to hold their value and give people the opportunity to, if they time it right, to roll things if they haven't gotten the benefit yet, and do it where it's not costing them too much, is that they try to maintain these positions. That's another benefit to VIX. I can give you benefits for both sides of the equation.
Well, that's a good point too, and that occurs on the other side as well when people buy put spreads in, say, UVXY. A lot of them hold up until right before expiration, and so same on the reverse with the call spreads, because as we know, a call spread and the put spread are just inverses of the same thing basically, and so you can get the value of that call spread right up towards near expiration and then roll it out at that time if you want, I suppose. I wanted to ask you about the other part of your article from the most recent one. You were talking about the VXST and how the very near term has sort of either held up or gone higher as far as volatility goes.
This past week, more often than not, regardless of what's going on in the markets, when we go into a 3-day weekend, you get a little bit of a headwind and VXST is the 9-day VIX. You tend to get, because you suddenly have an extra day off, and all the volatility indexes quoted at CBOE use calendar days. So when we suddenly have an extra day off, like today, that creates a little bit of a drag on the value of these volatility indexes, and especially on the 9-day version of VIX. And it had quite a week last week, and in addition to being up last week, it was also up on a week when the S&P 500 was up. And you've got to you got to wonder if a week or two down the road, we're going to look back, we're going to have some sort of a correction. We're going to be like, hey, man, that was definitely an early signal, because somebody is bracing for something. I don't think there's anything significant on the calendar for the next couple of weeks, but it looks like people are braced for more so than any other bullish week that I can recall. And I've been paying attention for a few years now.
It seems like when we've got the situation which we've been in for like the last month or so now, where we're really bottom feeding in the VIX. I mean, we've been bouncing off 9, 8.5, depending on how you look at it, where you are in the expiration cycle. And there seems to be, there's definitely a floor there for now, at least around 8. It's not like it's going to go to next week to 6 or something like that. It sort of compresses at that point. And I wonder how much the VSXT sort of curling up has to do with us just being bottom feeding and the sort of mispriced in the models due to days off and stuff, and how much of it is an actual signal of volatility perking up.
Well, both VIX and VXST last week had pretty good weeks, even with the S&P up and in front of a holiday weekend. And it's just all of those factors together. If it hadn't been a holiday weekend, I wouldn't have gotten as excited about it. The other thing was the longer dated volatility index has hardly moved. So it's not like we got this parallel shift up or down. We'll see if there's something that somebody is expecting something to the downside on the equity market. That's and again, digging through the calendar, trying to come up with something.
Well, that's what it's strange right now. We were waiting for the tax news for so long, and there was now that what's next for the markets? Is it building the wall? Is it Mueller?
No, maybe there's some sort of kind of relief rally, like, you don't want to be long volatility when taxes get done, and it looks like they're probably going to get that thing done. And now that that's behind us, there's a belief, maybe it's the opposite belief there, that what else is going to take us higher.
I wanted to ask you. I left the CBOE a long time ago, and I haven't been back since 2004, I'd say.
Okay.
And I did volunteer for the Options Institute as they would come in and do mock trading, and I would help out.
How fun!
With Dr. J and these guys, and we'd stand in a pit, and they'd bring in people, and we'd pretend we were trading and stuff. So I remembered it back to then. But I was wondering if you could just describe for me the layout of the VIX pit and futures right now.
Sure. Okay, well, the VIX pit is it's where the OEX used to be, which that means something to about 4 of us right now.
Right, exactly.
But if you ever see the really cool old black and white photos of about 600 people jammed in, that's where VIX is now. Everybody has little stations where they can sit there, and they actually have computers. So there's about 60, 70 people in that space, probably more brokers than market makers now. And basically about half the volume, depending on the day, about half the volume is done open outcry, and about half of it's done electronically. Earlier this past week, we had a really large rolling transaction, or last week, that was 2 million contracts on a 2.8 million day. So that was all done open outcry. But any trades that I do, they're going to be done electronically. There'll be a handful of open outcry trades throughout the day. The SPX pit is bigger than when you were there. We actually added space to it in 2008 when that sort of thing was going on. It's still full. About 90% of the SPX volume is done open outcry. So, between those two pits, we've got almost 350 people still involved in an open outcry format. We've got about 3 posts left where they're trading equity options. One post is dedicated to the Russell 2000 index options and some other index options that don't trade as well as SPX and VIX. And there's one post that's a lot more ETFs than stocks, and one post that's more stocks than ETFs. So it's been narrowed down. About a third of the floor has actually been turned into office space for people that work at CBOE. In fact, a big portion of our research department is actually down on the floor. And the discussion that you and I were kicking around at the beginning of our discussion, talking about VIX hedging versus SPX hedging, that actually occurred down on the floor, down in their space where we were just talking about things.
Oh, wow. Well, that was my home for, I guess, 12 years. And so I remember it affectionately still. So you're saying that in the VIX pit, is it separated like into options and futures, or is all the futures electronic?
No. In fact, to circle back and give that one a little bit more, the futures and the options are physically in the same space.
Okay.
And when and this is why VIX, this is at the core why you value VIX options off the corresponding future. Those guys are using those futures contracts to hedge themselves when they're taking the other side of trades. So if they're doing that, that's when the rest of us may as well do that as well. The options on the ETFs actually trade in that same space.
Oh, wow.
And when you have a VIX option trade called out, they'll just basically call it out without saying what it is. They actually refer to VXX as double X. So which you especially when VXX is at prices that are pretty close to VIX, that's something that you have to be very careful about when they're doing trades down there. And there are a couple of brokers in that pit that seem to concentrate more on VXX, calling out VXX trades than VIX trades. But those are traded in there as well. So everything, all the different volatility instruments are traded in that space.
So when did the OEX go away?
The OEX left that space when we went public. 2010, 2011, I think.
Okay.
There were very few people left. We moved them. We moved them. We were going to convert that pit for the VIX guys because they were They were like in the walkways outside of the post where they were. They were just at a post. But we actually went public, and they rebuilt the NASDAQ market site in that pit for us to, open up their market for the first day that we went public. And then they tore it down. So it was like a 12-hour process. We should have done one of those cameras that took a picture every 5 minutes because it was just an amazing process. So we got all that set up. We've got all the networks there, and not a single one of the networks showed us ringing the bell at CBOE because Betty White rang the bell at the New York Stock Exchange by herself.
Oh my gosh! After all that setup,
not by an 80-year-old woman. That's the funny part of the story. But after that, they built it out for the VIX guys, and they've been in that space since I think around 2011.
So yeah, as you mentioned before, we are meeting at an interesting time right now because we're on a day off, and as I really noticed this morning that a day off in the markets doesn't mean the same thing as it did at one point. I mean,
no, I think that it seemed. When we launched VXST, gosh, I think about 3 years ago, we backdated all of the, so we had history going back to 2011 on VXST. And when we launched it, there was only one occurrence before a 3-day weekend where it had actually traded up. It was that much of a headwind. Since then, we've had 10, this past week was the 10th. Wow. And it's really funny. 2 of them were the last day of 2016 and the last day of 2017. What you're observing, I actually found in the numbers over the weekend.
Wow. Yeah, and I also just mean that there's so much stuff that trades 24 hours a day these days. Yeah. Like all the Bitcoins and things trade 24 hours. I've been gotten on the MJ stock buzz, and all the Canadian MJ stocks were trading today, and it seems like we're really becoming a 24-hour world. Now the VIX futures traded today for a little while. It looked like they traded from 2:30 in the morning till noon or something like that today. We
opened them for the European hours.
Okay.
Yeah. So, and they're since we've been open, we're calling it extended trading hours. We're renaming that global trading hours. I like that one better. There's a lot of cross trading between V stocks and VIX during those hours. They do correlate very closely. Sometimes they actually spread out if there's going to be a European centric event. Before, the French election, V stocks was elevated, VIX was not. Before Brexit, V stocks was elevated and VIX was not. And actually, the really interesting thing about both those cases is if you had bought VIX and sold the V stocks, you would have made money both times.
Oh, wow.
VIX caught up or V stocks dropped.
Now, are there options on V stocks somewhere?
There are.
Okay.
It's more of I pay more attention to the futures than and there's actually two exchange traded products now, EVIX and EXIV, that I think EXIV being the short one has gotten a little bit more traction than EVIX.
I noticed you discussing TYVIX also, volatility on bonds. That's a little bit of a new one to me as well. That's pretty interesting.
The behavior of it's not the same as VIX, and it's kind of unique to its own right. When we're trying to explain that volatility is different with different markets, I often use oil or gold, because you'll get a rally in gold and you'll see volatility pop up. You'll get a rally in oil, or you'll get a big drop and you'll see volatility pop up. TYVIX, we've seen it anticipate moves sometimes, and we've seen it react to moves sometimes. And the long-term range for that thing is pretty close to where it is right now on the low end and up to around 11 on the high end. And I just know I personally listen to, I make sure I listen to Bloomberg Radio every morning, either live or, through the podcast. And the last 2 days of last week, all they were talking about was, are we coming to the end of the long-term bond bull market? And so then of course I'm going to go look at TYVIX. TYVIX is not, it's not listening to Bloomberg Radio. How's that a way to put it? It was working a little bit higher, but it is still at really, really low levels. So the numbers are not telling me that there's some sort of fear that we're getting a regime shift in the bond market anytime soon. So that's where that kind of that focus came from. And you'd think, and TYVIX is based on the options on the 10-year futures at CME Group. And you would think if there are people concerned or speculating on a big move, that's a place that they would be placing bets that we're getting ready to get a big move one way or another in the 10-year.
I was in the 10-year bond trading pit for a brief period of time, and the 30-year pits over at the Board of Trade at one point. It's very different than trading equities. I never really got the hang of it. I don't think. Can you walk me through just briefly what's going to happen in the next day or two as we hit expiration in the VIX? Because I know we have an expiration coming up very soon, and when does it expire exactly? Is it like at midnight? Is it during the day?
It's AM settled like the old SPX options, which we still have AM settled SPX options. And the way that the process is, we do closer to an opening rotation like we used to do back when you were on the floor. We do this for SPX because it's a strip of SPX options that are used to calculate the final VIX settlement price. And it's actually the difference between the VIX calculation, and there's two big differences between the VIX calculation and the settlement calculation. One, the settlement is based on a single strip or a single expiration, the one that's 30 days down the road. And the other one is that the VIX settlement is based on the opening trades, not the midpoint of the bid-ask spread. So if you have an abundance of sell orders or abundance of buy orders off the open, that can actually impact the VIX settlement compared to where you see spot VIX trading during the day.
So do you think that leaves it susceptible to marking in some way or another? That it's not a midpoint?
It's, everyone, it tends to, there tends to be a pretty, I shouldn't say big, but there is a difference between where VIX goes out the night before, where it is quoted on the open, and the settlement price. But the settlement, sometimes it's above, sometimes it's below. I track it, and if you, it's really about, I think it's like 49% of the time it's a little bit lower, and 51% of the time it's a little bit higher.
So that's pretty good.
Yeah, and the other thing is, you hear, these sorts of things, and we address them all the time, but there's a lot. Let's say you wanted to, you decided to buy a bunch of VIX calls, and you were going to come in and buy a bunch of SPX options and try to push the VIX settlement higher. What happens when we come in tomorrow morning and the S&P futures are up 20 points because something has happened? I don't care how hard you try, you're not going to be able to budge, the VIX settlement. So there's this if you were going to try to do that, and I've played games where I'm like, if I tried to do this, how would I do it? I can't come up with a way that there still would not be some sort of risk in trying to do something like that.
Well, you get just general questions on StockTwits all the time about, oh, well, they're manipulating the price of the VIX or this or that. And the thing is that I try, being an ex-market maker, I try to explain to people how much money it would cost, even in a completely illiquid stock that only trades. You have a stock that trades 50,000 shares a day only, how difficult it is to even mark something like that, and what wall you could run into. And it wouldn't make financial sense to even try, and people still persist with these ideas. But
yeah, no, I came up with a way to do it that cost $200 million. And that was a while back too. That market has gotten a lot more liquid since then. I'm talking about 3 or 4 years ago. I think whenever, and this is just the nature of our business, whenever a number appears to be, a little bit outside of expectations, there's always this, or if the stock market moves up ahead of a very bullish economic number, oh, well, whoever they are, knew it was coming,
right.
And the same, you can tell me every economic number that's coming out next month, and I still not going to be able to tell you where the market's going. So it's the theoretical type of is much more difficult in the real world. That's you as an ex-market maker know that.
One of my big things with trading, I generally trade UVXY, I have an options positions in UVXY, and one of my big things is tracking the spread between the M1 future and the spot price. Some people call it the roll or the roll yield, and typically as the cycle goes through, it heads towards zero as we get to expiration. Right? I think. The futures were trading today, but the VIX was not trading, so it's not a good accurate reading right this second. But it went at about 50 cents, 40 cents, something like that, the last trading day, and we anticipate it getting to zero on expiration. Is that correct?
Yeah, between the spot and what they go out on tomorrow evening. Today's Monday. Tomorrow, Tuesday on the close, typically the futures and spot VIX are within a dime or 15 cents of each other. They converge, and any wiggle room in there is usually a little bit of just kind of market noise.
And the next month future that's coming online as the main traded future, that one usually has a spread of somewhere around like $2, I'd say. Is that accurate? Or?
In the current environment, I think it's been a little bit lower, but about $2 or so is pretty good. I was going to ask you, because this is one of those I would love to do some work on. Do you see any anomaly for things like VXX or UVXY on VIX expiration week, when those funds are suddenly, right now they're going to dump January and they're going to go to February and March, where maybe you're not getting as much, negative roll yield when we roll out there, or you're not getting as much downside pressure because there's so much time left to expiration. I've personally wondered and not done the work on it if there's some sort of expiration cycle trade in those ETPs.
Well, we had one hypothesis that this is sort of along a similar line that was that uh, the UVXY, or the, you could say XIV, it's the same sort of thing that has a roll, was more volatile the week right before expiration just because of the more pressure of the two to converge. It seems like in the first 3 weeks, the futures guys have more leeway to move around as they sort of see fit to. And I almost see the spread as sort of like a shock absorber. So if we get a little volatility injection into the market, they will not take the futures up as much as the VIX rises. And the difference between what the VIX rises and how much they take the future up is how much the spread widens. And it sort of absorbs a shock to the upside. And then as you go down, you see the same thing. The spread sort of comes out of the spread as volatility goes lower. So on a down move, you won't get as much of a down move in the future. On an up move, you won't get as much of an up move. And the big question is, how are those futures going to react at any one time? And how much of it is going to turn into contango, and how much of it is going to turn into the roll? And that's the question that we're all trying to figure out. And that's one of the reasons why I track the roll all the time, because it moves around a lot. And when we have periods like this, I've only been trading the UVXY for about 6 months, and the biggest exciting time for me so far has been this August. We got a move in one day where it went from, I think, UVXY went from 28 to 43 in one day, and we actually got to see the curve invert, and we got backwardation for a second. And I haven't been in an environment like 2011 where we got it for hundreds of days, or 2008 yet. Although I was around trading then, and I knew the market was going crazy. But so we're all trying to figure out what we're going to do when we actually get those extreme moves coming up.
Just real quick, I scribbled down where you mentioned the week before seems to be the more volatile week. The full week before expiration, which would have been last week, is when you really see a lot of rolling of trades, where you see a lot of January positions being rolled out to February. And that's going to have an impact on the January futures and the February future pricing. So that may be what you're seeing, is that working its way through to the ETPs.
Well, the other effect I wonder about is that first day, like let's say Wednesday of this week, when they first start having to roll into the next month. They first start having all these funds have to start selling Jan and buying Feb. And all of the futures guys have to adjust to that. You got to see there's got to be some effect to that. I really want to get some of these futures guys on to see how they manage their inventory at that time. Now, there's other sort of swaps and things that these funds use. It's not that they come in at 4:30 and go, Jan futures 100,000 to go. It's obviously a lot more sophisticated than that, but.
I really should be able to explain this better than I can, but there's a trade at settlement process where you can actually agree to buy or sell the various VIX futures based on the settlement price at the end of the day. And that book gets, that can be 10% of our daily volume right there. And that is really in place for the exchange traded product guys to roll their positions. But the other part of it is, in reality, you mentioned people using swaps to manage their book. I've sat on the desk of one of the exchange traded note issuers, and they didn't trade VIX futures that whole day. They had other ways of going about managing their exposure. The only ones that really have to, that are of size, are the ProShares guys. And when you take their leveraged long fund, which is UVXY, and VIXY, which is their long fund, and then compare it to what their exposure is with SVXY, it's really not that out of whack. There's not a whole lot. If they cross them among themselves, the market impact's not really the kind of things that you would read in the popular press.
So what you're saying is that they have two inverse products that sort of hedge themselves, that take care of
They have
themselves.
opposite products that are taking the one again. ProShares is the ETF one, and the other ones of size use ETNs. And if you take, they've got UVXY, but that's 2 to 1. So if there's $500 million in UVXY, they're managing it like $1 billion. And that's last time I checked, that's a pretty good estimate there. SVXY has a little over $1 billion, but it's not leveraged. So in reality, you've got one firm that's got offsetting long and short positions. So and I've met with government entities about this, not the SEC, but I've met with the Treasury Department and the Bank of England about with the groups that monitor hedge fund risk, and explain to them what the actual risk might be behind these things, and they're actually pretty comfortable with it. That it's not the dire potential exposure that people think that we've got out there because XIV and SVXY have grown so much. They've grown within a rapidly growing volatility ecosystem. I mean, our volumes were up 20+% last year in both the options and the futures.
Yeah, that's amazing. Well, that's good to hear, because you do get a sort of a little bit of maybe like, I hesitate to use political terms, but fear mongering from the press that every short trade ever in the VIX is stacked on top of each other, and they're all going to unwind at one moment, and the whole world's going to fall apart. Whereas actually, it's a process of several trades that are taken off over time, and there's two sides to every trade also. So it's
at one of our risk management conferences, one of the people that works in the VIX pit was asked what he thought the capacity was relative to the open interest right now, and he said we probably could do about 3 times the current open interest without really starting to worry about, or without having to go out and find more people to get involved in our market.
Oh, that's interesting.
Yeah, people that understand what they're talking about, whenever I have discussions with them, I feel I'm pretty comfortable with what's going on.
Now, do you notice any effect? I've been investigating a product called V-Men lately, which is it's associated more with a shorter end. I think it's not 9 days, but it's like 20 days out maybe.
The initial intent for those guys, and it was that they were going to use the weeklies, and they were going to target the time frame that you're talking about. What they've ended up doing instead, because of futures liquidity issues, they pushed it out a little bit, and they tend to be about 10 days shorter than VXX, or I guess in this case SVXY. So they'll have a good portion of the fund in the near, in this case, in the July, or in the, gee whiz, I wish it were July. I should look out my window right now. In the January futures, but they'll also have some exposure using different weekly futures. But yeah, their time frame tends to hover around the 20 days as opposed to 30 days. And so what you see is it's both VMIN and VMAX, which is their long fund. They're a lot more reactive to what's going on in VIX because they're more heavily weighted in the front month.
Okay.
Trying to think. And they are an ETF. That's the other thing I did want to say about that. They're an ETF, so they are getting involved in the futures markets each day. They're just not quite at the capacity of some of the other groups that have been around a little bit longer.
So what's the difference between an ETF and an ETN?
The ETF basically has to hold the positions that they say they've got. So, and I'll take it to a non-volatility example. If you have the SPY ETF, they've got to hold shares in the 500 companies that are in the S&P 500. And if you own a certain number of shares, like an institutional size, you can actually turn it in for the shares in the stocks, in the companies. An exchange traded note is a bond-like instrument. You could issue an ETN that gives people the returns that are equal to the total return of the S&P 500. And the way that you manage your risk to give people those returns, it's kind of up to you. So that's why when you and I are having this discussion about the ETNs versus the ETFs, and we're saying that they have other ways that they may be hedging themselves, such as swaps, the exchange traded notes like VXX will give you the returns equal to that strategy of having a 30-day weighting in the front 2-month VIX futures contracts. The way they hedge their exposure of giving those returns, it's kind of up to them. So that's why it doesn't directly translate into people trading VIX futures every day.
It seems like there's some tax implications as well, which it gets a little complicated, certainly.
Yeah, from day 2 at the Options Institute, I was taught to say consult your tax professional on that. But there are expiration dates as well. VXX and VXZ actually have an expiration in about 13 months. Barclays recently announced their plans to replace those.
Okay, yeah, that's interesting to hear that because a lot of people ask about that. I want to take you back just for a second and ask you about your background a little bit. I did a little research on you, and I saw you went to school in Memphis. So that's cool. And you've worked for a couple hedge funds, is that it?
Yeah, I worked for BAM here in Chicago. I worked for Caldwell and Orkin. I worked for a sub-advisor to Millennium Management for a while. All of those places I did a lot in the equity option space.
Now, how did they manage their options? Did they have like a separate person to execute options trades for their strategy? Is that the way those places work?
And, mostly option overlays, or really, gosh, 95% was selling puts where we'd be willing to get into a stock, or selling calls against the stock up where we'd be willing to get out of it.
Oh, wow.
So there's all these great, exotic, fun option strategies, but at the professional level, that's really what a lot of people are doing. Or, maybe selling a put spread where you at least limit your downside if the market starts to go against you.
That's interesting because I always wonder sort of what those guys are doing up there. So let's see. I have a couple of my subscribers had questions for you here. What would be your advice? This is kind of a vague question, but what would be your advice to a new trader in VIX products?
Read an awful lot. And actually the number one thing would be do not short volatility without some sort of a hedge. Do not, just because you see that selling the VIX 15 call has worked beautifully for 3 or 4 years now. Don't think that. Make sure you understand the full history of what VIX can do. We've gone through cycles. We've been in periods like this before. And 18 months down the road, VIX stayed above 20 for 3 or 4 years. So really you always tell people that when they get involved in any kind of trading, that you're really more about managing risk. That it means so much more in the VIX space or in the volatility space than really any other type of trading.
Sounds like good advice to me. Yeah. Do you think we'll have a big spike this year?
Yeah. And I'm not supposed to say things that are tradable. I have no idea when.
I was going to say, can you give me a date and time?
Yeah, that's the thing. It's not an if. It's really, they're going to happen. And part of do you remember the old O'Neill charts? They had the Investor Business Daily used to have this system where you would find stocks that had decent fundamentals that had been in a tight range forever, and then they explode to the upside. That's what VIX does. And we've been in a pretty long low range for some time. So it's really just a matter of some sort of unforeseen event sneaking up on the market.
Well, I think it's really helpful for people to look at like a 10-year or a 20-year VIX chart because you see it,
Yeah.
it's like an oscillator almost. It just goes up, down, up, down, up, down, up, down.
Yeah.
And to think that after going up, down, it's just going to stay down and not go up again
No.
is
And
silliness.
my favorite way to show off the what VIX does is the high-low average by year, and I've actually broken it down to quarters as well, because if anything, um, just focusing in on the high end, knowing what can happen, it's pretty. I mean, it's pretty useful. And I feel like even though I'm not at the Options Institute anymore, being at CBOE, big part of my job is making sure that people don't do things that ever get themselves in trouble with our products. So I overemphasize not being short volatility without some sort of hedge so much that I have people write me nasty emails about it. Like, who are you to tell me that? I'm not, but I don't want you coming back when things happen, when the market blows up and VIX runs to 40 very quickly.
Well,
Yeah.
it's very raw to watch StockTwits feed for UVXY because you have a parade of people coming in who
Imagine.
want to get long as a lottery ticket type thing, and then you have another whole camp of people who are convinced that to short it, and they're arguing with each other like everybody does on StockTwits, but there's not a lot of discussion about how volatility can go to a high level for an extended period of time, and that it's happened before, and that it most definitely will happen again. Um,
Mhm.
I want to ask you, what's your normal day like in your current capacity now with the SIBO?
Um, I'm doing a lot more research than I used to do, which is what I'm more interested in. Because in my new capacity really kicked in the first day of this year,
Oh, okay.
so it's changed a bit. I'm going to continue to do the social media on the weekends, writing up the what's going on in the volatility space and what's going on in the Russell 2000 space. Right now, I'm working on which of our benchmarks work best in different volatility regimes. Fascinating stuff, but that's the kind of stuff that the institutions are interested in. One of the things that I'm actually going to, that kind of the next project that your audience will probably find more interesting, is I'm going to take a look at XIV and SVXY and look at them compared to basically just being leveraged along the stock market, and get an idea of real, because really that's all you are. Is it's a leverage exposure to the stock market, the way those things are constructed. And I'm going to see if maybe there's a way that you combine, XIV and the SPY to get better risk-adjusted returns than just owning the SPY by itself.
The substitutes for each
But that's
other.
the kind of stuff that I'm moving into at the exchange. Is a little bit more academic, but applying the academic stuff to things that trade at our exchange.
Are you involved with the RMC conference that's coming up?
I am. I actually I joined that group actually, so I'm working very closely with Paul Stevens, who puts the whole thing together. I'll continue to go to RMC. I do all the video interviews of different RMC speakers,
Oh,
and
wow! Can you
but I have to,
tell
yeah,
can you tell my viewers a little bit about the RMC and what it's about?
absolutely. Risk management. It's we do 3 of them now. We used to only do one. We do one in the United States in a warm weather spot in the spring, and it goes back and forth between Florida and California. This year is Florida. And it's a 2.5-day event in the U.S. It's a day and a half in Europe and in Asia. Europe this year will be in Portugal, and in Portugal, no, Ireland. It'll be in Ireland this year. And it's like September 13th through 15th, I think. And then the Asia one is always in Hong Kong. And that one is usually, I've missed Thanksgiving the past couple of years because I got to fly over for that. But it'll be at that time. We haven't said the dates for that one yet. The cool thing about RMC, a lot of the conferences involve, you got a sponsor and they give you a speaker slot. We don't, that's not how RMC works. RMC is mostly buy side, some sell side people. And the buy side guys will actually talk about the way they go about using, volatility derivatives or SPX or something like that within their portfolio, or even to speculate. When we're over in Europe, there will be some talk of V stocks versus VIX. I think because we purchased BATS we closed that a little under a year ago. We're one of the largest ETF exchanges now through BATS. So there will be a little bit more of a volatility ETF component to it than there has been in the past. That seems to be working its way into the curriculum as well. If you go, I think CBOE-RMC.com, you can actually see some of the previous presentations. We have not finished the March schedule for Florida yet. I know for a fact. We had a meeting about it on Friday. That's why.
I was looking it up a little bit before.
Actually, I think the Winklevoss twins will be at RMC. They were in Hong Kong because we're teamed up with them for the Bitcoin futures that we're trading.
Now, the CBOE Bitcoin futures settle based on their Gemini exchange
Exactly.
prices. Is that it?
And this Wednesday, the 4 p.m. Eastern auction that Gemini, they do one every day, that will actually be the January settlement. That'll be our first settlement.
Oh, wow.
We haven't gone through the process yet.
So how's the CBOE Bitcoin situation right now coming along? Is it?
It's doing fairly well. Any new products, you really never know. Trust me, I don't think they ever thought VXX was going to have $1 billion under management.
Yeah.
Right now we trade between 5,000 and 10,000 a day. The future, we've got 39 unique institutions involved in it, and I know that because I've been looking at the COT report.
Wow.
You have to have at least 20 to qualify for the COT report. Ours is in the COT report. The CME groups is not. Theirs is 5 times the size of ours. Almost on a daily basis, they seem to be doing 1/5 the volume. So on a notional basis, we're doing the same. We just seem to have more participants, and I think the smaller contract. When both ourselves and CME were getting started on doing Bitcoin futures, Bitcoin was at $4,000. And people were giving us a hard time saying one contract per Bitcoin or one Bitcoin per contract is going to be too small.
Yeah, things have changed a bit since then.
Things changed over the course of those getting put out there.
What is the COT report?
The Commitment of Traders report.
Okay.
It's a futures. It's basically unique to the futures world. You can, and I actually spent a lot of time looking at the VIX COT report as well. But you can look at how leveraged money is positioned long or short different instruments. In fact, when you hear about VIX having a whole lot of short interest, they tend to be citing the COT report. But as a percentage of total open interest, the net short for VIX is around 25%, which is as low as it normally gets. It's not outrageous, and that kind of goes along with the same discussion I was having with you about the short VIX ETPs versus long VIX ETPs.
Are options coming on Bitcoin?
If the intent is to eventually list options as the futures reach a critical mass. I don't know what the number is for that. I do think that options on futures might be the first step as opposed to index options.
Do you think Bitcoin is going to actually go anywhere, or do you think this is just a trend?
I don't know. I think I actually wonder if what happens with Bitcoin is it's not a bubble that pops and falls apart, but maybe it's a bubble that plateaus. You know what you and I have been around long enough that whenever somebody says something is different this time, we're supposed to call BS on it. But there's just too many different elements to this thing compared to anything else that we've ever had trading on. It's very difficult to have a historical context to figure out what's going to happen next.
Well, I've certainly been wrong many times about Bitcoin in the past. I owned one at $1, and I've been wrong. I've been a seller of it the whole way up in my mind. And I've been wrong the whole time. So I've learned to keep my mouth shut and just watch what happens here.
Well, I think it's Tyler Winklevoss likes to say that we're in the 20th Bitcoin bubble.
Right. It
So
just keeps
that's
going.
another one. I think about it from the technology standpoint. I know some of the other altcoins claim that they have better tech than Bitcoin, better than the current blockchain. Part of me wonders sometimes if Bitcoin's going to end up being the MySpace and everybody's trying to figure out what's going to be the Facebook. You know, that being the first one.
I've heard that a lot. Yeah. That, like Alpha Vista was the first browser.
Yeah.
And where's Alpha Vista now?
Yeah, so. Exactly. There are probably lots of examples like that.
And are you still an active trader in the markets?
No, not really. Just because of where I work, it's not a primary thing. I do, small trades just I wouldn't be very good at talking about these things if I didn't do some trading. I've yet to do a UVXY trade. I tend to stick with VXX. I think that's just because that's what I started with. Maybe selling call spreads when we get a spike, that sort of thing. Usually just about always taking the other side of a spike.
Are you bound by regulatory to like?
Not necessarily regulatory. We have they of course, working at the exchange, like anybody that works at a financial company, they get all of my statements, they see what I do. The big rule that we have is we're not supposed to be trading shares or options on any of our member firms, because we actually might be able to figure out what's going on at the member firms. So
that makes sense.
That way, what I've always done is I just avoid trading anything on any options or stock on financials. That way, I don't.
Well, I sincerely hope that you're able to keep up with the blogs and all the stuff that we get, because we really we turn to it every week, and I know I'm speaking for a lot of people when I say we really appreciate all your work.
Thanks.
I know it's a small world of us VIX people out there, but we are out there, and we do. We do. I love the stuff from when we get the spikes,
that's
and the unusual activity is also very, very interesting for us, because it's hard to, it used to be trading a single listed stock as a market maker. I had access to all the order flow in the world for my products, and now it's everything's obscured and it's hard to figure out what's going on a lot, but you're able to provide some clarity for us. So thank you very much. I guess that's all I have for you right now. I appreciate you giving me a little bit of your time, and I'm very excited to talk to you. That's awesome with your new position and everything, and I wish you great luck moving forward. Maybe we can speak again sometime.
Well, you need to come to Chicago, and I'll take you back around the floor, and you can go, oh my God.
That would be great.
We get a lot of that, oh my God, from people that haven't been there in some time.
I try to look at pictures, but it's not the same as actually going down. I have one friend who's still in the pit down there, so he keeps me updated. He sends me a snapshot from time to time, but
okay.
It's been a while, so I'd love to get back down there sometime. But anyways, thanks so much for doing this, and it's been fascinating for me, and really appreciate it.
Okay, thanks.
All right.